Hey guys, Jackson from Twin Finance. Today, we're going to talk about quite possibly the biggest financial issue in everyone's lives, and that's debt. I'm going to teach you how to become debt-free. The first step to becoming debt-free is first calculating your monthly net income and then calculating your monthly expenses, guys. So get out your T4s, calculate how much gross annual, it'll tell you your gross annual income and then how much tax you paid. Then you're going to obviously divide that by 12 and that's going to give you your monthly net income. And then the next thing, guys, is monthly expenses. If you go for coffee every day, Tim Hortons, $1.50, $2 for a coffee, you got to include everything, guys. Mortgage, rent, property tax, anything that can be considered an expense, anything that's going to take away from your monthly cash flow, guys, you're going to have to include that when we do this. Okay, guys, so once you subtract your monthly expenses from your monthly net income, you're going to arrive at your leftover cash flow, and this is your freely spendable income per month. So if this number is a relatively low number compared to your debt totals, then you're going to need to either do one of two things, guys. You're either going to need to up your income or you're going to need to lower your expenses. This is really the only two solutions that lie here. Okay, before we talk about paying down debt, we need to understand one thing, guys, and that's no investing. So I've written down a scenario here where if you chose to put $6,000 on investing, what would happen? So if you put $6,000 into investments and you also carried a $6,000 credit card debt, that credit card throughout the year is going to cost you $1,260 interest, assuming a 21% interest rate. If you chose to invest that $6,000, let's say a good return on the year, when many investors would agree that 10% is fair, so 10% investment return rate. That leaves you with $600, and that's earned interest. This is earned interest, and that's paid interest, guys. So if you add those two numbers together, you're going to end up, and you're going to see that you paid $660 in interest this year. That means you lost money, guys. Okay, guys. Now we're going to look at if you chose to pay down debt with that $6,000 as opposed to investing. So if you look here, you see you carried initially $6,000 credit card debt, and this is the $6,000 payment onto that credit card. You'll see that you will collect no interest that year. You will have paid no interest at the end of the year. Now if we look over at investing, you didn't invest any money, so you're not going to get any return. So you're not going to get any money through investing, but you also didn't pay any interest. So that means you broke even, guys. And I'll take breaking even over paying money in interest any year, anytime. Okay, guys, so let's talk about debt. The average in Canada per household is $22,000 debt. So that's a considerable amount. So if you don't have a net cash flow each month of like anywhere in the neighborhood of like $1,000, you're going to want to somehow create that, guys, because it's going to take you, even if you had $1,000 per debt, assuming no interest, it's going to take you 22 months to pay this debt off. So you want to have a considerable cash flow. So once, like I said in the previous step, once you fix the cash flow problem, then you can arrive here. What I've written down here is interest rates, high to low. So the first thing you're going to want to pay off is things with the highest interest rates. This would be like credit cards, like a Tepperman's loan, like furniture loans, like things of that nature, guys. They have like high, like 20% and above interest rates per year. So you're going to want to pay those off first. And then the next things that follow after that is going to go in chronological order from highest interest rates to lowest interest rates. Okay, so now we're going to talk about paying down debt. So in this person's case, they have a total debt of $23,000. This debt consists of $6,000 credit card debt, $5,000 used car loan, and $12,000 student loan. They also have a $1,200 after expense monthly cash flow. So what they're going to want to do each month, take this cash flow and put it onto this debt. So they're going to start with the highest interest one, which is credit card. That's $6,000. So as you can see, if you do the math, 6,000 divided by 1,200 is in 5 months. Because your after expense monthly cash flow already includes your credit card minimum, you'll be able to pay this off in a little bit less than 5 months. And then after you do pay that off, you're going to be able to erase that credit card monthly minimum payment that you have to make. So not only are you going to erase this debt over here, you're also going to add to your monthly cash flow. So say his credit card payment per month was $300. Now he's looking at $1,500 monthly cash flow. So now just repeat the process, guys. He's going to take this $1,500, put that onto his used car loan, because that's the next highest interest rate. Once he pays that off, again, you're going to see an increase in his monthly cash flow as he no longer has to pay a used car loan. Then, as you can see, the process starts to speed up because he's going to have higher cash flow. He's going to be able to pay off the remainders of his debt quite quickly. Okay, guys, that wraps that up. There's 3 things that you need to take away from this video. The first would be the information that we just spoke about. Number 2 would be that you need self-discipline. That's the key to this whole equation, guys. If you do not have self-discipline, this is not going to work. So self-discipline in this case might mean you might not be able to go out every weekend with the boys, or you might not be able to go to that restaurant or buy those shoes when you want. But if you want to become debt-free, you need to have self-discipline, and that's the answer. Number 3 would be, at first, it's not going to feel like you're getting anywhere. There's going to be money coming into your bank account and it's going to be going right back out on debt, guys. But what you need to understand and know is that you are getting somewhere. You're paying off debt. You have less of a burden to carry around with you everywhere you go. And you have to understand that it's the process, guys. Trust the process. You'll get there if you follow these steps. And for more videos like this one, be sure to subscribe.